on to the Smart Property Investment Show with your host, Phil Tarrant.
How's it, everybody? It's Tim Neary here. I am editor of sister publication, actually, to Smart Property Investment Real Estate Business, and will be hosting the Smart Property Investment Show today in place of regular host Phil Tarrant, who is away at the moment. It's big shoes to fill, actually. Joining me on the show today is Eddie Dilleen. Now, Eddie was on the show just over a year ago. Very impressive young man who's been in the business a little while, and at the time had 8 properties in his portfolio and was just 25 years of age. Hello, Eddie, and welcome to the show again.
Hi, Tim. Thanks for having me. Excited to be here.
You're welcome. Now, I'd like to kick off with a very important question, and it's based, I guess, on a goal that you mentioned the last time that you were here. And the question is, what car are you driving?
It's unfortunately not a Mustang, as I said before. it's a Mazda 6 at the moment, but I had to put the Mustang on hold to purchase another few more properties.
That's probably a good plan. Now, just the backstory there was Eddie had been invited on a few shows, and there were a couple of things prior to coming on Smart Property the last time, and there were a couple of haters that were saying something along the lines of nice houses, but what about the car? There was the Holden Astra.
That's right.
At the time, and Eddie said then, well, when I get to 10, then I'm going to buy the dream car of the Mustang. So I guess that's still the dream, and it's still coming.
It is. It's one of those things, once you get to, a few places where you want to get to, you extend the bar a little bit more and you keep going.
Nice work. Yeah. Now, and that's a pretty good segue into today's discussions. What does a portfolio look like today? You had 8 at the time then, and you were aiming for 10.
Yep.
Did you get there?
I did. I got there finally. Wasn't the easiest thing to do, but I finally got there. I'm in the middle of settling on number 12 at the moment, so I was able to get there, but Fantastic. I didn't want to stop once I got at 10. I wanted to keep on going and, maybe get a few more under my belt and then get the car.
Tell us a little bit about those properties. Now, for the first 8, you had pretty much bought them away from where you live. Mm-hmm. Has that still been the case? Is that still the trend?
Yeah, most definitely. Like, I think for me, when I was, when I was growing up and everything, right before, some of the major markets started to take off, I was, 17, 16, 17 at the time. Then I purchased the first one, after I was 18 in the Central Coast. But then after that, I didn't quite have the amount of capital there after that to go ahead and purchase in the big cities. So I kind of started buying small properties, still within metro cities, around Queensland, Adelaide. And I just stick with the fundamentals of, buying small, buying smart, with high rental yields as well.
Because that's been your game plan from the start, hasn't it? Is to find well-priced, modest-priced properties, undervalued, with a high potential for rental income.
Absolutely, absolutely. That is the key. Like, I don't purchase out in the middle of mining towns or really far away from cities. The bulk of my properties are still throughout Queensland, within 25 minutes drive to Brisbane. Some in the heart of the Gold Coast, and about 3 more through only about 20 minutes drive from Adelaide CBD, and then of course we've got Central Coast, so only about an hour away from Sydney now, roughly. So
that's sort of the 25-minute rule from the CBD. What's the thinking behind that?
For me, I just knew overall, if we look at cities, from a geographical perspective, and just overall landmass and like the population, majority of people in the population is skewed towards the big cities. Like, we've got millions of people here in Sydney, out of about 4 million plus people that are in Queensland. More than 3 million of them are located throughout that southeast Queensland region. So in terms of population growth, there's obviously nature's going to take its place, and people are going to keep on populating. So it's just basic math for me.
And it just gives you that peace of mind that your property's not going to stand empty, that there's always going to be a demand for a tenant.
Absolutely.
Because that's the basic principle of the investment, isn't it? To keep the holding costs low, so you don't want it to stand empty.
Most definitely. Most definitely. And I'd be surprised, like a lot of people that I talk to, they're scared of buying interstate. They're scared of, buying for, further away from, where they live. They only want to buy around the suburbs and that kind of stuff, or where they're at. But it definitely limits, your growth perspectives, your opportunities. If you look at all the big, investors that do have, sizable portfolios, they do diversify into different markets and don't just limit themselves, because when you do limit yourself to just certain areas and where you're comfortable at, you get stuck with finance, low rental yields, and the rest of it.
Yeah, and that's a great point. I came across this saying some time ago, and I've sort of put it at the front of things that I do, and it makes a lot of sense. It goes along something along the lines of start where you are, use what you have, do what you can. And so to tie it into what you're saying now, if you have, that X amount of deposit, X amount of finance available, that's what you've got. So that's where you start, and then you go out and find what you can, looking for the things that you're looking for, which is the high yield and the well-priced, underpriced properties.
Most definitely.
Talk us through the properties that you bought. Where have you bought, and for how much, and what are the yields there?
Yeah, so a few of the properties that I bought have been mainly around the Gold Coast. So we're talking places like heart of the Gold Coast, Surfers Paradise, Southport, Broadbeach. Those types of areas where there's a lot of obviously rental demand there. One of them was a 1-bedroom unit. And I picked that up for $185,000. Okay. Obviously, it's none of the resort style holiday let kind of thing that can sometimes people, if they do look in those areas themselves, they get excited about. They see the resort style ones for really, really cheap, but not knowing that majority of the times they are not proper residential. They're company titled or unit titled, so that changes for finance. All the ones that I purchased are proper residential, so they're in smaller unit blocks of 6, 10 units in the block, and they don't have those restrictions for finance.
Oh, that's a good point that you make as well, because I think in the first podcast you talked a lot about doing the research and understanding what you're getting into, and this is a good example of it, is that not get caught up in something else, but just stay to the fundamentals and know what you're doing.
Absolutely.
Yeah. So did you buy all 4 of them up there on the Gold Coast?
I bought 2 on the Gold Coast.
All in that price bracket?
Yeah, some were around 185. Another one was just over 200,000, and then I bought another 2 in Brisbane as well. Okay.
And in the same price bracket with the same yield.
Yeah, pretty much. Like the ones in Brisbane's. I bought a townhouse in Brisbane for $160,000. That rented out for around $280 a week, so it was a massive rental return, about 9%. That's still only about 25 to 30 minute drive from the heart of Brisbane. First glance, they're not the most prettiest looking properties, but it comes down to the fundamentals of will they have a tenant in there? Yes. Are we buying it below market value, making money on the way in, not just hoping and praying that it's going to go up in value, which is a lot of people do, and that's why most people, as you probably know, they only get stuck at like 2 or 3 properties maximum. Ensuring they're bought under what they're worth is the key.
Is the key. Yeah, I mean, this is an investment. It's not a gamble. So we're not hoping here. We're not playing on hope. We're not betting. That's right. This is stuff that you can rely on to a certain extent. Yep.
For sure.
I wanted to talk a little bit, Eddie, also about your existing portfolio, the 8 that you had when you were on here a year ago. I think at the time you said that the rental yield you were getting was about 8% plus.
Yes.
And the combined LVRs across the portfolio was around about 65 to 70%.
Yep.
Is that still the case? How's that changed?
Yeah, for myself, a lot of people, sometimes in general, obviously, a lot of people will borrow a lot of money against existing mortgages and use that continue to keep growing after they've hit a certain point. Over the last year, I think right before just as we were on the actual podcast, I was speaking to Phil when I had a job at the time, which was full time. I was hustling to get more deposits and try to save more money.
And I think you said manually. At the time also you were working a second job on the weekends as well.
Correct.
Yeah, so selling tools and working in the bar, if I remember correctly.
Correct. That's right. So, at one stage I had 3 jobs. So I was working at 2 different bars and working the full-time job just to, hustle and save those deposits. Yeah. So I was working like a madman, but, it was for a reason. I don't do that anymore. But, so that essentially saved me from using a lot of equity up front, which I did use some equity here and there to, expand and grow, but I did save a few genuine deposits, recently as well. So I think it's a balance, and overall my LVR is still roughly the same. It's just sitting under about 70%.
Okay.
Because some of the properties I had grow, like I've even had the my first one, I've got that revalued, and that's went up another 60,000-70,000. A few of the other ones I purchased, there's 30 here, 40 there, 50 there. When you've got 8 of them, it makes an incredible difference.
They start to go up, and you say 70,000, but that's all for purchase price of around about 170, 150, 170. So those are significant increases in value.
Yeah, like that one, like the first one, for example, I bought for 138,000, and today you'd be looking easily, almost 350, something like that for all the 2-bedroom units around around the Wyong kind of area. Yeah, and then along with the other ones around Queensland, they haven't grown quite as much, but obviously they're a lot new. I haven't held them on for that long, and of course that's the name of the game. Is the more properties you hold for a length of period of time, the better your outcome's going to be. So
time in the market.
Exactly. Regardless, right now, if I stop buying right now, and I'm just turned 26 a few months ago, within 20 years they're all going to be paid off anyway. So even if they don't, worst case scenario, they're going to be paid off anyway.
Yeah. And I want to get to that a little later on in the show as well, in terms of what your plans are for them long term. But as a broad stroke, it's to hold on to them for the long term. Yes. I know that things change and there's little adaptations you've got to make along the way, but broad strokes to hold on to them for the long term.
Yeah, definitely.
You mentioned that you are no longer working all of those jobs. Do you still have the one job, the one single job, or are you a full-time property investor these days?
Yeah, I don't have any of the jobs anymore. I solely pretty much just work on property investing. After I did a few more interviews last year, towards the end of last year, purchased a few more properties, hit that 10 properties. It was lucky enough to, go on TV and do a few things in the media as well. That they caught a wind of that, which was cool. But then obviously I had a lot of people talking to me and wanting to find out more and, how they could purchase property as well. And then eventually we just started, helping people for free, talking to them over the phone, but eventually it became too much. So then I've pretty much just started my own property investment buyers agency to help other people too.
Okay, cool. So that's putting something back into the market and using that expertise that you've gained over the years.
Exactly.
And you made the point, didn't you, that when you started out, you spent a lot of time doing your research and understanding not just the fundamentals of property, but all of the things that go with that, the finance and the management of the management of the portfolio as well.
Exactly.
So you would have learned a lot along the way.
Absolutely. Yeah. I think in general for anyone that purchases, 5, 10, 11 properties or however many, you learn things along the way. Finance is obviously one of the biggest things. I mentioned that last time. To realize how finance works, you have to kind of think like, you have to know how a broker works, what their processes are in place. You have to study all these things and kind of become master at all trades, in terms of how to structure your portfolio, when not to cross-collateralize, what types of properties to purchase, when you're going to, have to focus on high yields and when you can relax a little bit. There's a lot of different facets to it, so for sure.
It's really impressive as well, because I remember you making the point that you wanted to give yourself options. So you were prepared to do the hard work early to get to the point later on where you were doing something that you wanted to do rather than what you needed to do. And your passion for property came through. I think you used the word, you were addicted to it. And so it's really terrific to hear you today saying that that's what you do. That's what you're doing full time. And you're taking that passion and you're taking that addiction, if you like, and you're putting it into something that really you understand and really, switches you on, ticks all your boxes.
Yeah, it certainly does. It's something, I get excited for when I'm waking up in the morning now rather than dreading, when I had to go and work for someone else and, worrying if what they were going to say if I was late 5-10 minutes or, take a too long a lunch break or something like that, sometimes dreading to, it's not that, everyone's workplace is like that, but, it
can get like that.
Yeah,
it can get like that. And on the other side of the coin, when you're doing something like what you're doing now, you never really work a day in your life, do you? When you do something you love.
That's right. I always thought that, once I hit 8, 10, 11 properties, and I had more passive income, as I've pushed up the rents and, negotiated on loans, have created more of a stream for myself, which equates to a small wage. So, I always thought that once I would do that, I just wouldn't do anything. I'd just sit on my backside and watch TV all day. But unfortunately, once you get hooked, and you just can't stop. And my brain just doesn't stop. It just keeps going. And I'm, live for property, and I'm always on realestate.com or whatever search engine and with, talking to agents, talking to property managers in the market and, so.
I'm not surprised to hear that, at 25, when you were 25 and having 8 properties under your belt already by then, it didn't seem like you were the kind of guy that was just going to go slow after that. It seemed likely that it was going to kick on. So that's great news, and it's really good to hear that. Any setbacks along the way? Any things in the portfolio that were unexpected, losing tenants unexpectedly, or any stuff like that? And I'm thinking more just in terms of, I guess, starting out investors, some of the things that they might encounter and how to deal with them.
Yeah, definitely. Like, I think I had another one I had a year basically where I had about 3 or 4 properties out of the property zone. A couple water heaters broke down. I had one needed an air conditioner put in, and I think there was a bit of damage in one of the other ones. Someone put a few holes in the wall. So yeah, things do come up, and it does affect your cash flow. And more importantly than ever, that's why you have to cash flow your properties and make sure the yields are really high. But yeah, it was sometimes were trying times, but you've got to think big picture. I see a lot of investors when they go to invest in property, they focus on $200 there, $500 here, $1,000 there, but they're not, and it sometimes stops them from actually purchasing a property. But then they're most likely within 20 years, they're going to look back and wish they did purchase that property because, over time, $200 here, $500 there, the property's most likely going to double within 10 to 20 years, regardless. So just to save a few bucks up front, can actually cost you a lot of money in the future.
And they're going to have forgotten about that those incidentals, $200, $1,000 here and there, when they see the big values that those properties are generating in terms of value then.
Most definitely. I feel that, strength, it comes in numbers. So the more obviously properties that you have, that are structured correctly, the more the results magnify over time. So, fewer properties here, if you've got, say, 2 properties, for example, and, both of them go, empty for a week or whatever for some reason. But of course, you bear in mind you have insurance for landlord insurance in case it does happen. But if it did happen, that would be your whole portfolio. If you had 6 or 7 or 8, then that's only a small amount, and your cash flow would, subsidize the
carry it through.
Yeah.
And you talk about that, don't you? You talk about the balance of that.
Absolutely.
Balancing your portfolio. Now, I know that we touched on this earlier, and it's terrific that you are now full time in the business because it gives you I guess a better place to give advice to others as we go forward. Now, I wanted to just tap into your brain for a second around starting out property advisors, property investors, or even those that have been in the business a while that maybe just need a bit of a refresher or interested in another point of view. So what are some of the things that people should know about, let's start with the fundamentals of property. What should people know about property? How does it work?
I think some of the things that I look for, really in depth, and it's, I guess it also is classified as being, fundamental and basic. But, I see a lot of people, they want to only purchase, for example, houses, because they obviously learn from their parents and that kind of thing that you purchase a house, has land on it, they only make so much land, and that kind of thing. However, looking at my portfolio, there's a mixture of some houses, some townhouses, some units, and that kind of thing as well. When you do only focus on houses, yes, you're obviously purchasing a lot of land, which is a good thing, but the rental yields on most houses throughout metro places like Queensland, Sydney, Melbourne, Adelaide, that kind of stuff, the yields aren't quite there. Say, for example, you're getting a house and it has a 5% yield. It's not too bad, but it's not going to win you any awards. It's not going to, put money in your pocket or even service itself after the council rates and water rates and management fees and, etc. You'll still be losing money. You'll be trying to claim a little bit of it back, which is, good for reducing your tax. But when you go on to 2, 3, 4, you're going to get stuck with finance 90% of the time. It's definitely having that balance, I think, and most people just only score towards houses. Whereas if you start small and, buy a house, buy a, townhouse, buy a unit, buy a house, then you can effectively grow your portfolio and not shoot yourself in the foot.
And I'm hearing you say also think about the future, think about where you want to go with it, and don't sort of paint yourself into a corner.
Absolutely. I had a trick which I used to do when I was up to around 4 or 5 properties, and I started realizing how banks work and how they service people, and how banks have different calculators and serviceability and checkpoints and that kind of stuff. I'd only basically purchase a property if, in fact, that I would know for a fact I'd be able to finance another property after it. So if I was going to buy a property for $200,000 and it rented out for $300 a week or $320 a week, say in the Gold Coast, for example,
yeah,
I would go to another lender or go to the broker who I was using or the bank manager I was using and say, factor in these numbers what this property I'm about to purchase and what's my borrowing capacity going to roughly be afterwards.
Just so that you would take those precautions so that you didn't dead end yourself.
Yeah, exactly.
Yeah.
Like I've spoke to a few people and they've got 2 houses. They're going to buy another house, in Melbourne, for example. 4% yields, 5% yields, something like that. They do it. And then afterwards, they can't borrow any money from the bank because they're all too negative.
And they're stuck, yeah. You mentioned also that you were dealing with, I think you said 2 of the big 4 banks. Is that still the case, and less with brokers, or have you expanded that a little bit? Or are you dealing with brokers? What's your view on mortgage brokers?
Mainly, it's still the big banks. Mainly still the big banks, but I have acquired some good mortgage brokers along the way to get the last few properties. So 2 of the recent properties I've purchased have been through brokers, and pretty much all the other ones are just directly through the bank mainly. I've also started purchasing a property through a self-managed super fund, which is a whole nother department.
Yeah.
As I'm sure you're aware. It's amazing for me to hear, and when I talk to people, they have no idea about, and they say, I thought you could only purchase if you had over 150 or 200k or 300,000 in your super. And I go, well, I'm doing it.
Yeah.
So, there's ways around things. There's a lot of miscommunicated information out there from people that, as a matter of fact, sometimes don't have any property at all. So you've got to be careful.
People make assumptions and then they set themselves up as experts.
Exactly.
Yeah.
Exactly.
Yeah. So you got to watch out for that and speak to the experts. And we're speaking to one today.
That's right.
Now, self-managed super fund and your portfolio is growing. What is your advice around putting together a professional team?
Look, most definitely, when I was getting started buying my first few properties, I was, obviously reading a lot of books and that kind of stuff, but I didn't have anyone there I could turn to. Like, no one in my family ever, owned an investment property, or any of my friends and that kind of stuff. So I kind of had to just learn by trial and error. But nowadays, obviously, you've got a lot of people that do have more experiences. So number one, obviously, talk to someone who has done it before. Shoot them a message. They may be available to talk to you. Depending if they're not busy or not. But yeah, so obviously get help from someone who's done it before. Someone who has properties that you aim to do. There are a lot of companies out there where sometimes people that run the company, they only got 1 property, but they say buy 6. So you got to take it as a grain of salt and make sure you do your research.
They just wouldn't have the experience, would they, in terms of the kind of things that can go wrong or right when you're managing multiple properties?
Yeah, exactly. So obviously, if you're looking to build a portfolio, help fund your retirement, or, create wealth in the long term and, get yourself in a better position, obviously seek out someone who's done it before. So that would be number 1. Number 2 would obviously be read as many books as you can, for sure. So, you've got to also do your own research, property investment books, and, educate yourself on that. Whoever you use for a broker, obviously they have to be efficient in helping structure a large portfolio. A lot of people, I've got a few people that I've spoke to who they purchase with friends and they purchase with family members, and they go back to purchase in their own name and they cannot get finance. So that is a huge thing. The way that comes back to learning about finance, how banks look at, a person's debt when they purchase it with someone else's name, or, with a family or friend, or in joint names, in structuring your portfolio basically. So learning about how you should purchase each property. I would have got stuck very quickly if I started buying with, my brother or someone else, or, sister or family member, and then try to purchase my own name for, the finance reasons.
That would have meant that you wouldn't have got to the 12 that you got to today.
Exactly.
Does that revolve around, and I don't want this to become a finance podcast, but does it revolve around equity and the loan to value ratio?
A little bit. A lot to do with servicing. So some banks only will take in, a portion of, so say if you've got, this is from my experience, and obviously, I'm not a financial advisor, but this is from my experience and dealing with people who have done it before and they've got themselves stuck. If they purchase, for example, in joint names, you're looking to purchase with your partner or your sister, for example, and then you go back to purchase in your individual name, the bank will usually assess that first property as you own the debt 100%, even though you are splitting it with your partner.
Gotcha.
So they're going to consider the debt 100% in your name, even though you're only responsible for 50% of it. Take it with a grain of salt, do your research regardless. Also, when it comes to rental income for that property, so say if it's 400,000 and it's $400 a week rent, and they're only going to assess usually half the rent.
So they're going to be as conservative as they can,
exactly,
in terms of making their serviceability calculations, I guess.
Absolutely. So, one wrong move in terms of buying one property, and you're done for. You're going to either have to sell the property off, restructure it. If you do that, you can sometimes incur stamp duty costs if you do transfer it to someone else's name. So structuring is a huge thing, along with finance, along with finally finding the property. So
you're losing in the short term because it's costing you money, and you're losing in the long term because you no longer hold it, and it's not accumulating value for you, not accruing value for you in the long term.
Yeah, most definitely.
By making a mistake early.
Yeah, so, just by
a finance related mistake. Yeah,
exactly. Just by structuring the wrong way.
Mate, it's been a real pleasure to have you back in the studio. And again, congratulations. I've still got my eye on that Mustang for you. I'm looking, the next time you're in, we're going to ask you about the Mustang. No pressure, but we're going to ask you about that. Congratulations on the new role with the buyers agency, and all the best for that as well. And on the 12, and I guess I've got one last question for you, and that's really, what is your plan going forward, and also the big picture? How do you see the property investment market developing this year and beyond?
Yeah, look, plan for me is definitely, I don't plan to stop buying anytime soon. I plan to hit 20 properties. Is the next one I want to hit. I haven't exactly put a time frame on it, but I'm obviously going to push as hard as I can to get there.
Have you still got some borrowing capacity to move into?
A little bit, but it's something I'm going to have to work towards. And, certain things I've done recently to, cash flow my portfolio has been, to negotiate fix, a decent amount of properties. So, save 10, 15,000 here in interest. Also, when you have a large portfolio, say if you increase the rents by $30 each and you got, 10, 11 of them, that's positives another 15,000. So you're switching around $30,000 worth of cash flow.
Gives you some leverage when you've got some volume.
Options as well. Yeah.
Options.
Definitely. Yeah. But yeah, for sure. So for the, for the market moving forward, I definitely see that, this year, 2018, obviously you've got Sydney and Melbourne, the two leaders that are, if you've been watching the media, hearing that they're slowing, a fair bit. For Sydney and Melbourne, obviously, I see that, it's going to continue to, plateau. It might some 5-10% fluctuations, I think, overall, but I still lean towards, I classify that as overall flat, up, down, 10 down, up, down, 10 down, or I don't, see any crash coming or anything like that. Supply and demand game. For the market, which I'm mainly buying in, is, obviously Queensland and Southeast Queensland. I feel that there's, more opportunities there than ever. With the lower price properties, still within half an hour, there's amazing buys out there. High rental yields that aren't going to get you stuck with finance. So I definitely, Queensland's still I'm number one.
Still massive opportunity up there.
Absolutely. Yep. I've got a couple in Adelaide as well. And Adelaide's, it's just the, kind of the story of the tortoise, just keeps on going and ticking along, and, long-term growth, from the past has been great, and high rental yields as well. So other markets like that, I don't really look too much in Perth, obviously a little bit on the decline and that kind of thing. Tasmania, seen a lot of publicity lately.
Hobart's getting a bit of a word, isn't it, just lately?
Exactly. Yeah, exactly. It's something that to potentially look more into, but I wouldn't put all my eggs in one basket. Definitely diversify, think outside the box, and don't limit yourself to just where you live.
Cool. Eddie, it's been a real pleasure. Thanks for coming in.
Appreciate that, Tim. Thank you very much.
Nice
I appreciate that.
Nice one, mate. Remember to follow us all on the social media stuff, Twitter, Facebook, LinkedIn. You can follow Phil also on Twitter @PhilTarrant if you want to do that. If you've enjoyed today's show, leave us a 5-star rating review on iTunes. It's the best way for new listeners to find us and for them to hear the great content that we are putting out. As always, smartpropertyinvestment.com.au is where you'll find us. There's plenty of stories on the business of property investment across Australia there. And on my guest today, Eddie Dilleen. Thanks again for tuning in, and we'll see you next week. Goodbye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.